And good morning once again, options traders. Well, it's time for another episode of Idiotic Ideas. This is number 5. Don't pay more than $2.50 for LEAPS options. So, for those who may not have seen the previous 4, I got this from a book that I regretted buying. It's just packed with really dumb ideas. But I thought, hey, let's turn it into a positive and use it as a source to show traders what not to do. So, as before, I'm not going to mention the author or the book, but let's just say that he does hold himself out to be an expert, ran a newsletter back in the 90s, I think it was, claims it was a very successful newsletter, and comes across as an authority on options. And if you don't really know what you're doing with options, in other words, you don't know what you don't know, yeah, this guy could come across as being an expert. So I'm just trying to show why you have to be so careful where you get your information from because there's a lot of really bad information out there, and this is one of them. So let's go find out idiotic ideas number 5. Why is it such a bad idea to suggest that you shouldn't pay more than $2.50 for LEAPS options? Well, we'll go find out here, and as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So, as a direct quote from his book, he says, buy cheap options, options priced under $1, or $2.50 for LEAPS. Now, a little footnote here before we're even getting going. Right off the bat, we've got a problem here because you've heard me talk about before that options really aren't priced in terms of dollars. Yeah, that's the way we see them on the quote board, but that's really a misperception. They're priced in terms of volatility. And yet, right here, he's not even mentioning anything about volatility. He says just buy a LEAPS option if it's under 250, and that will somehow make it a good deal. Well, that's not necessarily true. That might be a really bad deal. It could actually technically be an expensive option. So, that point aside, let's go find out, even if we're going to price them in dollars, why this is really going to be a bad idea. And you're just most likely never going to find a single trade that will qualify. So first, let's talk a little bit about LEAPS options. Remember, this is really, it's a trademark from the Chicago Board Options Exchange, the SIBO, and it stands for Long-Term Equity Anticipation Securities. It's a tough one, but it's nothing more than a long-term option. Anything with more than 9 months to expiration. So, nothing really unusual about them other than the fact that they have a longer life. And that does open the doors for some interesting strategies when it comes to volatility or vega or possibly with interest rates. But other than that, they're just long-term options. So let's start off with in-the-money LEAPS. I've talked many times about the benefits of things like the stock replacement strategy or why you might be wanting to remove yourself from volatility or from vega. Get away from the extrinsic value. Lots of reasons why we might want to trade in the money LEAPS option. But there's a problem with this. And that's because options must trade for at least their intrinsic value. So if the stock is 105, you know that the $100 call must trade for at least $5. Now that's all $100 calls. That's a principle of all options. Got to trade for at least intrinsic value. So even if this $100 call has 10 seconds until expiration, got to trade for at least $5. If it has 3 years until expiration, got to trade for at least $5. Now also, LEAPS options generally trade in larger increments. You're not going to find them in $1 or $1.50 increments like you will in a lot of other expirations. They're usually going to be $5, $10, or $20 increments. So if you're going to follow this advice that you should never buy a LEAPS option for anything more than $2.50, what that means is that in-the-money LEAPS are not possible to trade. And yet they can be some fabulous trading opportunities and strategies. He's completely erasing them off the board. All right, so now that we've crossed off in the monies, what about at the monies? Well, to understand why this is also going to be difficult, we have to turn back to some option pricing ideas. So first of all, remember that prior to expiration, call options must trade for at least the stock price minus what's called the present value of the strike price or of the exercise price. And it's this present value that allows us to calculate the cost of carry. And it's this cost of carry that will make most LEAPS trade for more than $2.50. So for example, let's put the stock at 100, the risk-free interest rate at 5%, and we're going to price a 1-year call. We're going to take the stock price, that's what the formula said on the previous screen, stock price of 100 minus the strike divided by 1.05, which is 1 plus the interest rate. And that comes up to be $4.76. And a way that we can check the math here is think of this as if you deposited $4.76 into a checking account that paid 5%. At the end of the year, it would grow to $5. So it's worth $5 in a year. That's called the future value, but it's therefore worth $4.76 today. So this option would have to trade for at least $4.76, and that doesn't even account for volatility. It is simply the cost of carry. And we're already at $4.76, well above $2.50. But there's more. We do have volatility to contend with. So to figure that out, we have to remember that the at-the-money strike really equals what's called the forward value. So if we have a stock at 100, 1-year $100 call, interest rates of 5%, the forward rate or the forward value is 105. That's just the $100 strike times 1 plus the interest rate. So again, think of it like dropping $100 into an account that pays 5%. It would be worth 105 in a year. And so therefore, the pricing model sees the 105 call as at the money. So even though the standard definition for most traders, it's incorrect, but this is how most traders will see it, they'll say, well, if the stock is 100, then the $100 strike is the at the money. And that's not really true. We would need to look at the forward value. The pricing model actually sees this as a 105 call. And now once we understand this, we can go back to another video that I did previously called the 40% rule. And what it says is that at-the-money options trade at prices proportional to their volatility, and that volatility proportion happens to be about 40% of a 1 standard deviation move. All right, so what does this mean? Well, let's take a look at a stock at 100, strike of 100, 365 days to expiration, 20% volatility. So we take a 1 year, remember that's the rate for volatility. It's always a 1 year period, very much like an interest rate. So we're going to take 365 days out of 365 days is 1. We take the square root of that number because option prices are proportional to the square root of time. So the square root of 1 is 1. And all that means is that we're going to multiply our volatility number here by 1. So 1 times 20% times the $100 strike or stock price equals $20. And what we're going to do now is say we're just going to look at the volatility component, and we're going to multiply that by 40%. So 20 times this 40% tells us it should trade for about $8. And look at that. Trades for about $8 because that is a 1 standard deviation move. 20% is the volatility times the stock price is $20. But also notice we didn't even account for interest in this. We just saw in the last slide that would have to be at least $4.76. And you're going to try to find a LEAPS option that trades for $2.50 or less? Good luck. It's just not going to happen, at least for an at-the-money option. What if we cut the stock price in half? Go through the same calculations. 1 standard deviation move is now 1 times 20% times a $50 stock price is $10. And what happens now? We multiply by 0.4, it's $4. And we still haven't even accounted for interest. So could you find an at-the-money option that's a LEAPS option that trades for under $2.50? it's going to be very hard. It's going to have to be a really cheap stock, something like a $10 or a $20 stock, very low interest rates, and you might be able to do it. But you're talking about maybe a handful of stocks that will qualify. Most stocks that are priced in that range aren't going to even have LEAPS traded on them. So the chances of finding an at-the-money option, LEAPS, that trades for 250 is again virtually a unicorn. You're just not going to find it. So now we've kind of come full circle back to this whole notion of finding LEAPS that trade for 250 or less. The only way to pay 250 for LEAPS or less is if they are far out of the money. And as I think everybody knows, far out of the money options have little chance for success. So think about it. His book is supposedly chock full of ideas about how to make tons of money, find all the free money that he talks about and the huge percentage returns and how lucrative it is to trade options. And yet, looking for LEAPS that cost $2.50 or less means you'll find lots of opportunities that are nearly guaranteed to fail. And that's what just makes it a dumb idea. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.